Hello, everyone, and welcome to Genius Wednesdays. Today is Wednesday, March 4th, and we are joined by Team Genius, led always by our head of market analysis, Steve Kwan. And Steve has quite a bit for us to get through today. We have many segments, including kind of a flavor of us looking at things through high, medium, and low risk profiles and what that means to different users. So if you are planning for your retirement versus if you're doing speculative investing, those are two very different high risk profiles. So that's going to be the lens for today. And with that, I will turn it over to Mr. Steve Kwan.
Thanks, Christina. I just want to start with one note not on here. It's not often that I truly hear kind of a fundamental story in crypto or blockchain, since, much of it is, I like this or I like that. I don't like this or somebody said this. But last night, the Supreme Court of India, I put this in Discord as well, they reversed the Royal Bank of India's decision to they're making cryptocurrency legal again. It is now an option for, I don't know, 1.3 billion people. How many of them use it? Don't know, no idea. But I thought it was a positive story where I'm sure there'll be regulation, which is fine, but at least I think when people hear that it's legal, maybe those that would not have been involved would be involved. And I'll move on to, over the past few weeks, I pretty much touch on Bitcoin, S&P, Eurodollars, dollar yuan, gold, crude. And it's usually more of a predictive analysis where I just want to kind of re-emphasize how things are very correlated in the long term, but in the high volatility moments, a la last week, and yes, if you look in Discord on Friday when the Dow was down 1,000, I did say that it would close unchanged, and I don't often make a price prediction. But moving on, I'm just going to show year-to-date charts of some of the major assets. I want you to just look at the slopes and formations of all these. So Bitcoin, high in February, came off. Dollar yuan, high in February, came off. Little different angle, but high in February, down significantly. Crude, the sharpest drop, really not much of a bounce. Silver, let's take a look at silver. Let's go back to S&P. So silver is an equity all of a sudden. Wait, let's look at this. Bitcoin, yuan. Bitcoin, yuan. We've said that. I sound kind of like a broken record. I'm sure many of you that have listened to these for the past, I don't know, half a year are like, wow, he's still talking about that. Well, when something works, do more of it. When it's not working, figure out what the problem is and don't do it again. So obviously the S&P was the strongest and it fell the hardest. Crude, yes, it got a bounce on Friday, but as you can see, still a ways to go. Silver, I don't know. I'm speechless. Gold, as you can see on Friday, even gold was not a safe haven. And I'd note yesterday, in the light of the Dow being down 900, the two positives were Tesla and gold. So does that mean that Tesla is a safe haven because it was up one day when the Dow was down a lot? I don't think so, but who knows? Now let's look at the outliers, the real drivers. I haven't really shown the 10-year before, but I guess if you've watched any business channel, you've probably heard the 10-year continues to hit historic record low yields. Under 1%, I think 94 basis points. This we have talked about for about 6 months, and it was an inflection point a few weeks ago. I know it sounds crazy, but as you can see in February, in just the past 2 weeks, LIBOR has dropped almost 100 basis points. I'll say it again, LIBOR. So I'm going to guess that many of you on here have a credit card, a mortgage, something where you pay some sort of interest. So between LIBOR and the 10-year, that affects a ton of people. I don't want to say all, but tremendous amounts. So now you are going to be paying less on your mortgage, less on your credit card, less on your small business loan, less on your car loan. What are you going to do? You're going to buy more stuff on Amazon? Maybe. Buy more Netflix? Maybe. Maybe have some more investable assets? Maybe. So where does it go? I don't know. That's up to you. But that would be the general idea where if there's anyone from Europe, I think they can attest. The savings accounts in Europe have been negative for the better part of a decade. I mean, this is really nothing new elsewhere, but I guess in the US, it's kind of the shock factor. Now, I want to zoom in where you saw all the different angles. Now, we're going to look at the past week and change. So these are all from February 23rd. Bitcoin, dollar yuan, S&P. So let's look at that. S&P, Bitcoin, Bitcoin, S&P. Anyone see any similarities? Kinda, maybe. Well, you don't have to answer. Crude oil. Wait, crude oil and Bitcoin are the same thing? Let's take a look. Low around lunchtime on Friday? Can't possibly be. Wait a minute. The S&P and crude oil had a low in the same 10 minutes? Maybe Bitcoin did too. Let's take a look. No, it was a slight delay, but hasn't really gotten much of a bounce. Let's take a look at maybe so silver, crude, and S&P all made a low in the same 5 minutes. That's odd. I didn't know silver was an equity. Wait, gold too? So gold, silver, crude, and the S&P all made a low in the same 5 minutes. Noticing any similarities when we come into high volatility, slightly different trajectories coming off the bottoms, but you can see lows, same 5 minutes, sharp declines, flattening, volatility should compress if it's a bottom. Option sellers get nervous, start to sell when the VIX gets to about 20. One more push towards the bottom and everything, bounce up, and then it should be good. But time will tell. That's just my opinion. Now let's take a look. Wait, the highest volume bar was in the same 5 minutes as everything else made a low, but the 10-year and LIBOR are just they're decoupling where it doesn't. I've never seen something where LIBOR hits a low, a Fed does another 50 basis points emergency cut last morning, and the Dow is down almost 1,000 points. But then again, lightning does strike. So as you can see, euro dollars here, same thing. And I guess that's one of the points I was trying to make last week is that when people are under extreme stress or markets are under extreme stress, and I can attest to this at least from my firsthand experience, if you get the tap on the shoulder, like, we need to cut some risk. I'm not thinking, hey, I'm going to sell a little bit of Bitcoin and maybe buy a little. You just hit that button, get out, get out, get out, get out, get out. Whatever it is, long, short. And you can clearly see that what people's positions were short interest rates or short fixed income, long everything else. And now they've gotten back into everything else and so on and so forth. So that would be it. And this is my coming soon. Why Bitcoin needs to decouple from the rest of blockchain and cryptocurrency. I know that sounds crazy, right? The first thing needs to decouple. I'll give you 3 examples. So here's how it sits currently. Total market cap, everything else, 90. The 50% points, 125 billion. So that means everything else, in theory, can only increase $35 billion if Bitcoin never increased nor decreased again. I know that's not realistic. Let's look at some other unrealistic things. What if Bitcoin went to $1 or went to 100,000 overnight? Well, at $1, the total market cap of everything would be 2.8 billion, and everything else would be 700,000. So if Ethereum, Bitcoin Cash, Litecoin, Cardano, EOS, everything else was worth 700,000, would we be talking right now? I don't know. My guess is probably not. Would there be podcasts? Would there be shows? Would there be an industry forming? Probably not. But why would everything else die because Bitcoin went to 1? On the flip side, what if Bitcoin went to 100,000? Did everything else get that much better? Should Ethereum be 3,000 a piece? Should Bitcoin Cash be 4,000 a piece? Did everything magically get 12 times better overnight? I don't think so. So that's my whole point, is that with the current system, if everything can only equal 50% of Bitcoin, but since it's the primary trading pair, and if everyone wants to redeem, it can't be worth more than 50%, then you have a problem, because Bitcoin, as it decreases, the incentive for all other projects to move on decreases, and it has to increase for others to grow. Where if there was just something, an intermediary where everything were the main trading pair versus this something, which I don't know what it is, then you could have kind of unlimited growth, but you still have, very finite things like Bitcoin or Litecoin, and you have non-finite things that don't end, such as, other projects. And that's my conclusion. Christina told me to kind of keep it shorter. So 15 minutes. All right, that's it.
Thank you, Steve. Well, I appreciate all of the chart analysis. We definitely saw a dive last week and heard lots of chatter on the social side of things. As we've mentioned many times here, that, the crypto landscape is 24/7, but it needs to be compared against the traditional capital landscape. And the traditional capital landscape and the global economic engine is changing, as we've discussed. I agree with you on BTC decoupling and letting the industry kind of mature a bit. We will have a deep dive report for our audience here in the next few weeks, coming here from Steve, where you guys can peruse that to your heart's delight. With that being said, I will turn it over to the team to ask questions about analysis from this week, and any correlation questions, any kind of insights. And I know Steve doesn't make a lot of price predictions, but guys, feel free to ask your questions here. And what you don't get to in this call, feel free to take that into Discord and ask your questions and follow-ups there. So with that, I will turn it over to the team. All right, you guys are going to make me call on people. All right, Jeremy Bourne, very interested to hear your thoughts from Steve's presentation, and then we will turn it over into the myriad of topics that we can get into today. And Jeremy Bourne's going to stay on mute. All right, very good. All right, well, Samson Williams, I'm going to pick on you. If you can go ahead and give your analysis. I know you have a bit of a deep dive report. Happy to crack open that coconut as well, and the team can start digging through all the implications.
Hello, Christina, and all you beautiful people listening to Coin Genius Wednesday. All right, Genius Wednesday. Okay, so yesterday when we were talking, or when Christina mentioned this during our dry run, I heard how different people categorize low, medium, and high risk profiles. And I was like, okay, that sounds great. And then I got off the phone and I was like, today while I was walking around, I was like, what does it actually mean? And so immediately in my head, when I thought of how people categorize low, medium, and high risk profiles, I thought about unconscious bias's role in investing. And then I was like, well, I should probably unpack that a little bit because people are going to ask, well, what's unconscious bias? And so unconscious bias are implicit biases, are learned stereotypes that are automatic, unintentional, deeply ingrained, universal, and able to influence behaviors. Most people don't want to talk about unconscious bias because it makes them feel very self-conscious, because you have to talk about things like race, sexism, and all the other isms. And so there's lots of unconscious bias training programs that are out there that are designed to expose people to their unconscious biases and provide tools to adjust automatic patterns of thinking and ultimately eliminate discriminatory behaviors. So again, most people don't want to have unconscious bias trainings or be aware of their implicit bias because they're like, I'm not a racist. I'm like, that's fantastic. And so when we think about how different people categorize low, medium, and high risk, part of it is understanding how people just approach different information, different data sets, and different circumstances. So there's all kinds of resources out there for you. You can take a Myers-Briggs test. You can take a color insight test. And those things help you understand your personality, number one, your attitude, number two, and help you see that, hey, perhaps I do have some unconscious biases. Every so often people say, oh, you look like a doctor. I'm like, really, what does a doctor look like? And they're like, oh, a doctor looks like this, or you look like a banker. Or they'll describe someone as a blue blood, or a company as a blue chip company. Most often we see unconscious bias come to the forefront when we do that proverbial thing where we judge a book by its cover. And so these are these things that society has told us are socially acceptable from a person who looks like a particular way. And of course, it's like, Samson, what on earth does this have to do with how different people categorize low, medium, and high risk profiles? Well, this is one of the reasons that right now, what are we in? March of 2020, there are more men named John in the C-suite than there are women executives out of Fortune 500 companies. And that's also why less than 2% of VC funding goes to women, because of our unconscious bias in investing. And so a critical component to unconscious bias is just creating awareness of your implicit bias. And when you carry these biases around and you're unaware of them, you don't know how much they're affecting the decisions you're making in the market. They're affecting your decision to buy, sell, or trade a specific asset. And so how this applies nowadays, there's a wonderful book by a fellow anthropologist. His name is Robert Shiller. He wrote a book called Narrative Economics. And the narrative economics is basically how stories go viral. And he explains the story of something called Bitcoin. You've probably all heard it. And he's like, Bitcoin it has value because here's the story that people bought into. Here's what they believe, and here's how Bitcoin got value. And so many people don't believe in narrative economics. So we'll use an example more pertinent to today, how people make emotionally driven decisions regardless of what the data says. If you've been watching the news, you've heard about this coronavirus, COVID-19. This is a story of narrative economics and implicit and unconscious bias. So generally, the risk of getting sick from COVID and dying is less than catching the regular flu. However, the majority of folks, particularly in America, we can't be bothered just to get a flu shot, wash our hands, and do other little common sense things to keep ourselves healthy. But when you look at the narrative, the narrative economics of COVID-19, it's everybody's gonna die. Even though when we look at the actual data, very few people, yes, more people will be tested. As more people get tested, more people will test positive. But of those who test positive, they don't have the mortality rate that the media would have you believe. And so part of that is, oh, we've got these unconscious bias of how this disease came from China. I was in a Chinese restaurant yesterday. It's one of the best dim sum places in DC, and there's typically an hour to an hour and a half wait. But right now, you can walk right in. It's empty, and I love it. But this just shows that, oh, we have a lot of unconscious bias. And occasionally, when you combine our unconscious bias with narrative economics of how stories go viral, you can say, I can really see how different people and their attitudes and their personalities, how they categorize low, medium, and high risk opportunities. And so I'm going to make a last sort of joke about Ripple, because when we kicked off this call before Christina hit record, she said we couldn't call them doo-doo coins or poo-poo coins. So she could edit it out. And I was like, oh, you don't have to call them doo-doo coins or poo-poo coins. You can just call them XRP. And so here's where you can these two things of unconscious bias. You just don't know what you don't like and what you do like. And narrative economics comes together to help create a person's unique risk profile or risk appetite for investing. So personally, if Ripple goes public, Ripple the company, I want to be an early investor. I absolutely want to be an early investor if Ripple goes public. Why? Because I'm going to be able to buy in very low. I'm actually going to hold my XRP. And then once at the IPO, I'm going to dump everything. Why? Because the common perception is, hey, let's look at Ripple. It looks great. People take all of their unconscious biases and Ripple markets to them. They say we're the greatest company since sliced bread. And so they're not differentiating between Ripple, the business, and XRP, that thingamajiggy that they sold to participants / investors. And so we're able to, marketers do this really well, particularly for political campaigns, where they market to your unconscious bias. We call it code switching. And so they want to hit upon those things typically that create fear, uncertainty, and doubt, because you're not aware, because you haven't taken one of these personality tests, Myers-Briggs or Color Insights, of your unconscious bias. And so once we have a feeling for this certain demographics, unconscious bias, how do we play to them? And so in the case of Ripple, I think Ripple is a fine company. I think XRP is secondhand toilet paper, because they are two completely different things. And so when we look at someone, when we want to categorize people's low, medium, or high risk profiles, someone who has a low risk profile would invest in Ripple, the company, but they would not invest in they would not invest in XRP, that thing. Because someone with the low risk profile, once they did their research, they would say, hey, Ripple is a business. XRP is a product. It's a thingamajiggy. If I own Ripple, I own Ripple. If I own XRP, I do not have any equity in to Ripple. And so as we think about how marketers in particular focus on and exploit our unconscious bias, we can think, how am I being manipulated? If people know I'm in a low risk or a medium risk profile for investing, how are they then packaging their financial offerings to me and selling them to me? And I think the end of this is why CoinGenius exists, because humans, we'd love to think we're making data-driven decisions when we're not. Because at the end of the day, if we don't trust our gut, if our gut tells us don't do it, we just won't. It doesn't matter what the data says. And so that's why if you're listening to this podcast, that's awesome, because when you go on the CoinGenius website, you can see the gut check moment. You can see the data. The data is what the data is. Yes, there's some bias in data from time to time, but Steve Kwan and the rest of the team, they're always worried about cleaning up the data. We had a phone conversation where Jeremy was like, hey, the hedge funds, they want clean data. They can't do anything without clean data. And so when you have an opportunity to look at the different products on CoinGenius, it's this data. I will be aware that I have unconscious biases that are impacting the way I make investments, that are putting me in these different categories of low, medium, and high risk. But now that I have aware of myself and my tendencies, I can now look at data and attempt to bifurcate the way I feel about a given product versus here's that business move I'm going to make. Here's that business decisions I'm going to do based on the data. And so that's where I think that unconscious bias and narrative economics come together, particularly when we delve down into that. How are we going to categorize people into different risk profiles, particularly for investment, into low, medium, and high? So that's my thoughts for today. If you have any questions,
Thanks
let me
so
know.
much.
Okay.
Christina, can I add a couple things?
Please. I mean, we're all about the data, and I'll just make a quick comment that CoinGenius will create the platform for people to self-identify so that we can help get you the products that you're looking for. But yes, this is very complex, and Steve is about to crack open something that basically alludes to the way that I look at high, medium, low risk is different than how Wall Street looks at high, medium, low risk is different than how, my grandmother who's, saving for her retirement looks at high, medium, low risk. So through all of those lenses, Steve is constantly looking at the data and kind of just putting himself in those different positions. So Steve, I will turn it back over to you.
Well, to start, Christina and Samson are extremely polite by saying, I'm an idea generator. I'm old school. I have an idea, and basically now some quants, or in this case, I generate an idea, and CoinGenius gives the data to back it up or prove it or disprove it, essentially. But my comment on to Samson is on Ripple. Whether Ripple Labs becomes a great company in the equity markets or not, I don't know. Couldn't tell you. Can't predict the future like that. But I agree, and I actually wrote a piece which Christina was kind enough to edit and make grammatically correct on Medium about that, where cryptocurrency's use, at least now, for most of these projects, I'll say most things except for the Litecoin, Bitcoin, Ethereum's, etc. It's the third method of capital markets raising capital. I mean, there's equity, debt, and now crypto. I go to a website or Discord or Bitcoin Talk or Telegram, and somebody has a new project. I'm giving them money. I'm buying Bitcoin with money, and I send it to them, and they send me something else, something I can't see or touch. And then they then use that Bitcoin or Litecoin or whatever I sent them to help fund their project. I mean, call it what it is. When you hear the team selling, of course they are. How do you think they're moving forward? Like, they have to. But moving on to the high, medium, and low risk. The highest risk person is someone who's undercapitalized and over leveraged. I know that sounds obvious, but in short, leverage is more risky than not. I know that sounds like, oh, everyone knows that, but when I hear guys that go from, in the equity markets, I think it was 14-to-1 leverage on S&P futures, and I know on some exchanges, I think in Bitcoin you can leverage 100-to-1. If you're that good that you can predict the next $5 in Bitcoin, you should go talk to Goldman or Citadel or B of A or JP Morgan, because they'll give you a lot more than 1 or 2 or 10 or 50 Bitcoins to play with. But it's a game to just eat people alive. Where leverage, it sounds great when you win, but I'd say that on Friday, when the NASDAQ was down 500, the NASDAQ futures are $20 a point. That's $10,000. Initial margin was 7,000. You were done by lunchtime if you didn't answer the phone. So that's the highest risk. The lowest risk is someone, in my opinion, who basically is, I'd say, an extremely passive manager, where let's say you wanted to allocate, you had 100 grand and you wanted to buy 12 Bitcoins. You're not trading it, but you kind of peek in on it once a day, once a week, with some frequency. So if you bought 12 at 9,000 each and it's 8,000 an hour later, maybe you want to reevaluate. You check the news, but maybe you get out, maybe you don't. Depends what your risk profile is. Oh, and I guess finally, the buy and hold, just saying I'm buying and holding for 10 years, I believe is, it's not one of my strategies. I think that in a market that looks at things by the millisecond, if you're looking at it over 10 years, it's extremely hard, because the market will frustrate you, and a la what Samson said, they'll probably get you at the absolutely wrong time, where peeking in on your investment, even if you're a long-term player, every week just to see, hey, where is it? Oh, Bitcoin's unchanged, Litecoin's unchanged, gold's up $2, the S&P is down $5. You know, you're at least cognizant of it. In '08, when I heard, oh, just don't look at your 401k statement. When you seriously have someone from JP Morgan or a large entity saying that's horrible. You know, don't look at if it's losing, but if it's winning, start looking at every second. And finally, those that are long term that start looking at things on a daily basis, they will drive themselves insane, because if your time horizon is 3 months, 6 months, a year, and now you're looking at Bitcoin, say, on a 1-minute chart, you're not sticking to your strategy. And vice versa, if you're a 1-minute trader and you start thinking, well, the Bitcoin could be, I'm short and Bitcoin could go to $1 in a year, or I'm long, it could go 100,000. But that wasn't what you were playing for. So I think that whatever one strategy is in any, I guess, asset class, it's just stay true to your strategy. Like if you're long term, look at those charts. If you're short term, look at those charts. Looking at things that are outside of your realm of investment or asset allocation expertise will, in the long term, probably not be financially beneficial. That's it.
Yes, Steve. I wanted to add now because you've given us some. I like the leverage profiles because I'm thinking, how am I going to make you FOMO if I don't understand your personality? Because part of the risk profiles in my head, they equal personality types. Because if they didn't equal personality types, otherwise we'd be talking about data-driven decisions. And in theory, your data-driven decisions should be very similar to each other. And so thanks for adding that passive managers and that buy and hold for 10 years. Because even if you're going to buy and hold for 10 years, how did you come to that conclusion? How were you pushed, or what information did you absorb that you said, hey, I'm going to hodl until 2030. Call me back then. And so super interesting conversation. Can't wait to hear some more conversation about this.
We like round numbers, though. I've yet to hear. I hear people, oh, I've been in for a year, I've been in for 5. How many guys you know that they have a 7.5-year time horizon? Or my time horizon is 32 months. I don't know. I guess that's one of those embedded things. A year, a week, a dime, a dollar. Bitcoin's going to 10,000, it's going to 1,000, it's going to 1,000,000, it's going to 0. Whatever it is, it's not never, but that's another term. If one uses absolutes, never, can't, always, won't, has to, generally speaking, I'll shut the door on that real quick, because in my opinion, only God can see that. I can't say with 100% certainty that anything's going to happen. So
Right.
that's another thing to, I guess, watch out for, or keep one's eyes peeled in the investment world. When you have to do this, or this has to go up, it's probably going the other way. Or this can't go lower, it probably will.
I would agree, Steve. I think that that's a big piece of what we do at Coin Genius by quantifying the sentiment through natural language processing, or NLP. When you guys hear me say NLP, you can truly start to quantify those words and the frequency of how many people are doing it and the frequency of how often those people do those things. And that can start to lead to indications of like pump and dump schemes and all kinds of clarifying behavior when you're looking at the data. To Samson and Steve's point, the data that we're looking at can be sliced in many, many different ways. And that's why it's important for CoinGenius to, be able to give our users what they're looking for, because different strategies need different data points. And to Steve's point, you want to operate within, your realm of expertise, but we also want to help educate you into things that you might not be so familiar with by just giving you the data points and the people and the numbers behind these projects and how the fundamentals of the crypto mechanics actually work versus the blockchain mechanics of how that works in the company. So all of that can be quantified, and we're going to be sharing that with everyone. So we're coming very close. Yep, go ahead, Steve.
I got one more comment.
Please.
And like I said, I'm not an investment advisor, so I'll just say things that I do or don't. But something that I have done and I found very useful is I'll just use if you're a 10 lot Bitcoin trader or investor and implied volatility is 10, then your metric is 100. If all of a sudden Bitcoin volatility goes to 100, then I would size my positions down so my risk profile is kind of constant, where a 10 lot Bitcoin trader in a 10 vol environment is far different than a 10 lot Bitcoin trader when it's moving $1,000 a day. So I would say that paying attention to implied volatilities and external markets, I've found to be very useful.
Steve, can I ask for one more comment from you? We talked this week and over the weekend about, our exchange ranking strategy and our coin ranking strategy. And you said something very interesting about BTC and why it would score low in some categories, but off the charts in other categories, and that it's very meaningful to you. Can you share that a little bit with the team here and just give a sneak peek? I won't hold you to anything and I'll create all the categories properly in the system. But if you can just give a sneak peek and kind of rephrase what you were telling me over the weekend.
Gosh, I talked to you about so much stuff, it's hard for me to recall.
I'm
But
thinking particularly the
I
one
know
where
I'm
you
kidding.
said
I'm
if
kidding you.
BTC was ranked
Right.
000, but then
Okay.
they're 10, 10, 10 here.
So I guess there's certain, to me, the ultimate metric is liquidity. Can I get out, or can I, if you're short, can you get it back? If you're long, can you get out? Like, is there a stopping point of your pain, or if it goes to your target, can you get out? Because in illiquid names, it doesn't really matter. I mean, if I'm the only player in ABC coin, it can go from 1 Satoshi to 10 trillion Satoshi, but it doesn't matter because I'm the only person. I'm playing with play money. So in that metric, Bitcoin gets an 11 out of 10. It has the liquidity. And even if you couldn't trade any Bitcoin, since it's the primary pair, it not only has its liquidity, but if I were to need to hedge 100 Bitcoins, I could go to the Ether market, the Bitcoin Cash. So there's a lot of other ways to get out, either way, long or short. So that metric is important to me, and Bitcoin gets an 11 out of 10. On other, on exchanges, well, it's on pretty much every exchange. So that's an 11 out of 10. What are the OTC markets? Is there one Saturday at 2 in the morning? Yes, there is. Will you pay more than on Monday at 2 p.m.? Yes, you will. But like I said, you can get out, you can get in. And I guess on other parts, where is it the fastest? No. Is it is there a 1-800 help me line because I broke my Bitcoin wallet or something? No, I don't think so. So is there a community? Is there a Discord or Telegram where someone can tell me? I don't believe so. I mean, there's by far the most eyes on it, so it tends to have the most information flow. Can I talk to one of the developers if I have a question? Most likely not. Is there visible leadership? Someone that's the CEO of Bitcoin? No. So Bitcoin is one of those extreme cases where by the metrics I look at, it's off the charts both ways where it would get a 0 in can I talk to someone? But like I said, the ultimate metric for me is can I get out? And I guess that's why people say the old Coinbase coin. When I started and made $1 or 2, I just looked at, well, is it a Coinbase coin? Can I get out? Can I use it at a bullion dealer? Well, you can use Ethereum, Bitcoin Cash, and Bitcoin. So all of a sudden, Ethereum was as good as gold to me. And I think that people that are trying to emulate that, the largest projects are all mining based. There is no leader, there is no CEO. So that's what I mentioned to, an attorney and some people at the CFTC and even the lady who was talking at that show
Hester
in
Pierce.
Chicago. I talked to her,
Hester Pierce. Yeah.
Hester Pierce, and I was just telling her my thoughts on what have more equity properties, what have more commodity properties. Like Ethereum's deemed a commodity by the CFTC unofficially because it's on the CME website, and I think that you can't comparing gold to a crude oil drilling company. It's not a fair compare. I can't compare the two. I can't compare diamonds to how Apple runs its business. So I guess that's what leads to my next story of the next coming weeks is comparing everything to Bitcoin, where this is a portion of Bitcoin. It really is an apples and oranges comparison. Like Bitcoin has by far the most liquidity, so that's its use case. Like people can use it, they can spend it. You can spend 1 million, you can get a market for 200 300 million up, and it won't be as ridiculous as you think, where you can't do that in most what did Samson say? Most of the other projects, they want to have spendability. You put a small project on a debit card, I'll bet you in a year it's done. It's zero because they don't have the buyers lined up on the back end. So that's my other thought on random thought, but yeah, the
Yeah.
crypto debit card for small things, deadly. If you don't have a second, kind of a market tier of bids and then an institutional tier of bids to buy if someone, decides to spend quite a bit.
So I'll clarify that statement and I'll give a little shout out to our community. Daniel Goldman at Turnio with the block card, that comment was for you. We have some suggestions about how to help your market making with the Turn coin. But we will be getting into all of that and evaluating all of these projects on those property rankings, like Steve was saying. So, Steve, thank you so much for the comment. Appreciate it. You actually made a great segue into, the biggest projects are mining projects. So, with that, we're going to turn it over to Dustin Minch for Hash It Out. And Dustin, if you could today maybe put a little flavor around low, medium, and high risk profiles, that would be really helpful.
Yeah, you kind of put me on the spot on that one.
Just a flavor.
Just a flavor. So I guess I guess I'm not really fully understanding the question. If you could rephrase it into
Sure. Excellent. So the way that traders, you bet. So traders of all types fall into a category of low, medium, and high risk. And that might look differently to those users, i.e. someone planning for their retirement versus someone using speculation dollars are two very different strategies for mining, because it really comes down to hash power, energy, and the computational power of the computer. There's not so much of low, medium, high risk, but there is different price points that you would enter into. Like if a low risk miner, if some of these products don't even exist yet. I know that you and I and Carl talked about, creating a mining kit that hangs out of your window and is solar powered, for apartment use. There's all kinds of things you could do in the future, but for low, medium, high risk, for those entry points, for someone who is either really well versed or not well versed, needs the education, how does someone get into mining, and how would mining be categorized in low, medium, and high risk?
Well, I think that, low risk would be, if you're, for low risk people, the first thing that comes to my mind is say, you got a computer at your house, but it's an older computer and you've been meaning to get a new one, right? And you're like, well, but you were also looking at getting into mining. Well, the first thing that comes to my mind is if you're going to go out and buy a computer or build a computer anyways, then why don't you just spend a little bit of extra money and build something that's a little bit more robust than what you actually need? And that way it can kind of have a dual purpose, meaning that you could use it to check your email, do a Facebook, do whatever it is that you need to do on your computer. And then when it's idle, when you're not using it, you can configure it so that it mines, maybe something like Ethereum or Zcash or, any of these newer cryptocurrencies where you can actually accumulate a decent amount in hopes that they go up in value. Or maybe you just, you want to go the lazy man's route and you download NiceHash onto your computer and it just mines whatever is the most profitable for your hardware, and it liquidates it into Bitcoin. So that to me would be like a low risk. I'm more of a medium risk would be, to me, is to build like a step up from that, which is like a dedicated GPU mining rig. And so the reason why I would classify that as a medium risk is because you're investing a little bit more. You're probably going to spend, with a regular PC computer, if you were going to build it like a gaming / mining rig computer, you're probably looking at somewhere around $1,500 to maybe $1,000 to get that built. But if the market goes to crap, who cares? Because you still have a gaming computer that you can use for something, right? Like it's still serving a purpose in your home for something else.
It's a repurposed asset,
yeah,
right?
it's a repurposed asset. So then, if you're going to go if you're going to build like a GPU mining rig, which is very, very, very similar to a gaming PC, except it's configured in a way that it holds multiple graphics cards. So it's not just going to be able to hold or house one or two like a normal PC case would. You're going to have like a custom built case that can house, 6 to 8 GPUs. And the main reason why I classify that as medium risk is because there's still a way out. Because even if the market goes to crap, or if you need that money back, you can sell those graphics cards and those computer parts for right around, 50% of the value, the retail value of what you purchased them for. In some rare instances.
Oh, Dustin, that's a good note too around
Yeah.
the marketplace and the timing of when you're purchasing that equipment. Just so the audience knows, CoinGenius will be tracking that too. And there's an intention to get you guys mining marketplace for deals and when things are more or less on sale. So you're not paying those full retail prices. We understand that there's a need for our community there too. So sorry to interrupt, Dustin. I just wanted to let everyone know that.
No, that's fine. So like, with GPU mining, there's kind of a hedge there because you can get out of the market with that. And then, the next profile up from that is ASIC mining. And I consider that, if you're going to do that at scale, it's a little bit more high risk. It's typically not designed for, you're not going to mass deploy a bunch of ASIC miners around your house. I mean, you can probably get away with a couple of the newer ones they just built, which is what I want to really focus on. But, if that ASIC miner, if the profitability and the efficiency of that goes out, that computer it's not like you can use that ASIC miner to get on Facebook or anything. It's specifically built for one thing. It doesn't even have a browser in it. You can't even surf the internet with it. So if the profitability in the market goes down, it's kind of like a race to get out and see who can get out the fastest, because it's a paperweight at that point. There's no
i.e.
repurpose
the upcoming Bitcoin
Yep.
halving, right? I mean, that's basically what you're alluding to.
Right. And so, if I was to put them in profiles, those are the buckets that I would put those in. Now,
can I ask you one more clarifying question?
Sure.
For enterprise level, i.e. the partnership that we can't talk about yet, that we're still formulating up in the wings. If you have low energy and a big partnership from an enterprise level, how would they look at low, medium, high? You might want to start with high, because I think what we're doing would fall in that high speculative bucket versus other approaches. And I know you can't talk too much about it, but if you can kind of allude to that for the enterprise high, medium, low, that'd be helpful.
Yeah. The first thing that I would look at is what the electric rate is and see if it's fixed, or what kind of guarantee that I would have on that. Like, prices may look good at the beginning, but like, what is the utilities, what is the historical data for that consumer, for that electrical rate? If you get a commercial rate, maybe do the history on that utility company, say, okay, well, this is how much they've increased the electric rates over the last 20 years. Now that's, there's no exact guarantee, but that can give you an overall idea what they might project for the next 20 years. And, if you can get it fixed, if you can get like a 20-year agreement fixed, you're golden.
So really dumb question.
Yeah.
I'm sorry to interrupt. If you have the fixed energy and like for the endeavor that we're looking at, and it's fixed bid, the risk still comes in with BTC halving. The risk still comes in with like the competition that you're in, right? How much competition is in the world, and so like the halving is like right around the corner. I mean, it's happening in May. Do you have any like futuristic crystal ball forecast for what that means to the mining community?
Well, there's going to be one or two things that are either going to happen, you know, and that's really where your electric rate comes in, and the term how low can you go? Because, if you got your electric rate negotiated to a penny and the halving happens and the market doesn't go, bananas like everybody's projecting, well, then there's going to be a lot of miners that are going to unplug. Now, the beauty to that is that as more miners unplug, the ecosystem around Bitcoin mining self-corrects. It corrects itself. It's self-correcting. So that means that, there's more rewards being distributed to the miners that stayed plugged in versus the other ones that got pushed out because their electric rate wasn't in place or whatever. However, I would have to suspect, I'm under the popular belief that, yes, we may see some dip around the halving just because, I feel like, the big market makers are going to try and make this, give it one last shakeout to shake out a lot of weak hands so that they can get a bunch of cheap Bitcoin and then ride it up. But, and I don't really know where I was going with that, but that's kind of my projection on that. But as far as like, doing things at scale, that's kind of where your risk kind of goes up because you have to have a lot of your ducks in a row. You don't have whole lot of room for error and margin because, if I only get a couple of GPUs running around my house, sure, that might only run my electric bill up maybe 30, 40 bucks a month. Well, could I lose 30, 40 bucks a month? Sure. Right. But if I got 600, 700, 800 GPUs running each month and my electric bill is $6,000, $7,000, well, I better have enough capital to back that up. So, there's a lot of things that have to go right when you're doing it at scale. And so, there's a lot, I would be the first to admit that, I don't feel like I'm a huge at scale miner. Now I do spend a significant amount of money on electricity, but in comparison to some of these large mining farms, they got their cooling costs in order. They got their electricity rate and they got their hardware in order. And so that was my next thing too, is, Bitmain just launched a brand new ASIC miner called the S19. Now, I did do a YouTube video thinking that the S17 Plus was going to be the Bitcoin miner to get, but something told me, my little tingle spidey sense told me that maybe just hold out for another month or two and see what the market's going to do. Because I was planning on buying one of those S17s and running it at my house. But lo and behold, Bitmain just released this new S19 ASIC ant miner, and it's got almost right around 40 more terahashes for the rig at right around 3,200 watts. And so I'm thinking that that's the one that I'm probably going to get, but they haven't released any pricing on it. But if I was looking to deploy a Bitcoin mining farm, I probably would want the vast majority of my Bitcoin mining farm to be at around to be with the S19, mining with the S19 hardware, just because the profit right now, even at at the current market price, that thing's going to make right around $9.22 a day. And so at and I'm going to suspect that's going to come in at a $2,000 price point. Let me see here real quick. So if it comes in,
Sebastian, we're gonna run out of time here, but go ahead and look that up. While you're looking that up, I'll just share with the team here. On the Coin Genius Discord, you can get a hold of Dustin and ask all of your mining questions. I kind of peppered him this weekend about cloud mining groups, and I peppered him a little bit about this, ASIC 19. And I likened it to, this is kind of like, when the new Air Jordans come out, you want to scoop them up,
yeah,
and their price is going to go up definitely. So
these are the new easy
sharing
monies
that
right
with
here.
the team.
Yeah, you're looking at a 220 day. If that Bitmain miner comes out at $2,000 at the current market price, you're going to look at your return on investment at 222 days is when you're going to be in profit on that, which isn't bad. But obviously, if Bitcoin's price goes up, that ROI time goes significantly down. But That's been the big popular discussion. And, you know, the other thing to really think about, and I'm going to shut my mouth after this, is do the research though. And the biggest thing that makes me question is how long has Bitmain been holding back on this miner, and how long have they sold this to other private pools, and how long have they been mining with that equipment? Because that's usually how it goes. You have to know somebody on the inside.
They got to QA it.
Yeah. So, you know, it just makes me suspicious that, you know, they probably have been mining with this equipment for the last 6 or 7 months, and that's why the difficulty shot up. So,
interesting. Well, I always find it fascinating that, you know, traders want to see BTC price go up and miners want to see it not go up. That's always an interesting spectrum for me. So Dustin, you'll be available in Discord to answer anyone's questions.
Sure.
Steve is also available. Team Genius is available. We welcome you guys to come get involved in the conversation, learn, do your research, ask your questions, and really just participate in this new industry. So with that, I will ask really quick, does anyone have any last statements before we wrap up? All right. Well, very good. Thank you, everyone, for joining us here at Genius Wednesdays. We really appreciate it. You know, you're joining us here with the geniuses at Coin Genius, and you know, please come join the conversation. You can always get a hold of us at info@coingenius.ai. Thanks, everyone.